Big ideas start with a spark. At TASIS, we use that spark to ignite the fire in ourselves and our kids. So with the trust we build and the knowledge we share, we can grow together and stand tall, creating opportunities to advance in business while setting an example for the next generation. Whether you are starting fresh in Portugal or expanding globally, we're here to support each other. This is more than a network. We are a community that sets the examples for the leaders of tomorrow.
Who in the room has any crypto? Hands up. I can see a few. Someone might have to, Matthew might have to look in and let me know.
You see, I think we've probably got malfunction here. About 15 hands up, roughly, Kate.
Okay, cool. What about, in terms of financial terminology, how many of you feel comfortable with sort of traditional financial concepts like liquidity, collateral, and centralized regulation?
Far fewer than I would have hoped.
Okay, what about newer financial terms like digital assets, NFTs, stablecoin, and DeFi?
We've got a few hands
Few
going
more,
up.
okay.
30, 35, maybe hands going up.
All right, guys, that's a helpful summary. Thank you. I'm going to intro these four people who are really impressive, and then we're going to try and download some of their insights so that we can all become experts in the next 25 minutes. So, to my left here, Kellogg Fairbank. He has had leadership roles across fintech, digital asset, payments industries, including being the CEO of Nash and the CRO of Terox. He's been an international sales leader at online payments player Braintree, which purchased Venmo and then sold to PayPal. And his newest venture, called Trust Builder, was launched here in Portugal, and it is using blockchain tokenized smart contracts between the chain of property owners, developers, and investors, particularly trying to fix the problem with energy performance certificates that some of you may have experienced in properties here. So then to the left here, we have Rupert Barksfield. He is a serial entrepreneur across AI, fintech, Web3. Started as a teenage eBay trader, performer, and events organizer. Rupert built and sold a digital agency and then was an early crypto fanatic, leading fast growth firms, Amulet, which is a DeFi insurance company, and Sensei for employee offboarding knowledge. He's now building Century, another business that's very much founded here, all about wealth optimization for all of us. And then we have Ivan, and Ivan is a quantum techie, and he did his training at Bank of America, where he traded everything, apparently, running prop desks and also portfolio teams. He's founded Blockchain Systems, a large-scale crypto mining data center, and he's currently growing Pennyworks, which is a crypto bookkeeping platform for Web3 and financial institutions. And then last but not least, we have at the end Sashi. She is a financial services, digital assets, and fintech sales and strategy leader. She's worked at Wall Street giants to fintech scale-ups and digital assets pioneers. She's worked at many big names that many of you will have heard of, the likes of Goldman Sachs, Merrill Lynch, Symphony, and Coinbase across New York, San Fran, London, and Lisbon. She's also the advisor to Nova University's Blockchain RegTech Initiative and Web3 Creators Collective board member, and currently driving go-to-market strategy as the Chief Commercial Officer at Treasury Spring, the global institutional cash investment platform. So, big intros. Hopefully that's all been digested. Right. The reason I have notes, by the way, is I just got off a plane from Seattle, and I definitely haven't been following any longevity advice in this session. Way too over-caffeinated and over-alcoholed. Okie doke. I'm going to start to my left. Kellogg, big question for you. You've witnessed digital wallets, crypto, and blockchain in your career profoundly shift the way that money moves around. What do you think are the most exciting things happening right now in terms of the way we think about money?
So I think for most of my career, innovation in money was about moving money faster and cheaper. And I think, it's a super exciting time right now because it's not just about moving money and moving it faster and cheaper. It's actually, money is becoming smarter, right? What I mean by that is that money is able to, with everything that's going on, you have the ability to, define what all of that does, right? So with regards to digital wallets and everything else, instead of sending it from A to B, sending money globally, you're able to now define smart contracts saying that if money is hitting certain milestones, then the money is released. So escrow payments and that type of thing. So it's not just about moving it faster and cheaper, but it's money is becoming smarter, right? And I think that has fewer it results in fewer delays, fewer risks. The intermediaries, the people that are in between those money movements are no longer present, and it's now being automated, right? And that's what I think makes it super exciting. I think it's a very exciting time. It's only going to grow, and I think it's true for all real-world assets itself.
Yeah, okay, we've had a lot today in other sessions about the world of work speeding up, but also certainly the world of financial markets is speeding up as well. One of the new asset classes that everyone is talking a lot about is crypto. So I'm going to ask Ivan now in terms of the volume and I guess how important crypto might become. So apparently there are now 560 million users holding crypto. There has been a drop recently, although we did just chat about this backstage and Ivan's still not convinced that it's a significant drop. Do you think it's going to become mainstream, and what does this mean in practice for everyone in the room?
So I want to just underscore one point, is that the other partners are really interesting, artificial intelligence, investing, and so on and so forth. But the Future of Finance panel is probably the most important one to your daily life. Why? Is because whatever you want to do, it really translates to whatever you want to transact. When you lose the right to transact, you lose your freedom to be an agent in this economy. And so the future of finance is basically the battle of who decides you have the right to transact. Is it the banks, the intermediaries, the payment processor, or is it you individually whenever you need to do something? And that ability to transact is essentially the revolution that's coming out. You're getting much more agency on your wealth and on your ability to do things in the economy without a third party saying yes or no. So to just preface that. In terms of the asset valuations and things like that, it's really another discussion where finance is a way to represent a specific asset in a financial term. So you don't own gold, you own gold ETFs. You don't own real estate, you own real estate investment trusts in the United States, or you own a bundle of stocks. So you already have the financialization of real world assets right now. So how is it different when you convert that into a world that's financializing using traditional paper, lawyers, documents, and regulators versus on the blockchain, where you can directly transact with the actual assets as well? So the contrast for that is essentially since around the 1950s, this is the very good parallel is the euro-dollar market. Euro-dollar market is essentially dollars that were outside of the United States. So in the 1950s, it was initially used by large central governments to basically control their wealth because it was difficult to store any assets and trade internationally by shipping gold. Now that market grew to maybe 70 billion over the course of the next 10 years in the 1960s. And in the early to mid 2015, it went to $16 trillion. So that is a span of 40 plus years where it grew, and there was a very tremendous impact on global trade. Everyone's settling and transacting in dollars. And right now we have the analogous development happening in the crypto markets. Stable coins, US dollar coin by Circle Financial or Tether coin by Tether. Right now the market cap for the outstanding coins are around $100 to $200 billion. And it's been growing at a pace that's much faster than the euro-dollar market. So if you envision that, just slightly extrapolating that line out to the next 5 to 10 years, that could be another $10 to trillion of stable coins that are being brought upon the market. And those stable coins will be there for a reason, because they want to transact on the blockchain, they want to invest on the blockchain, they want to buy stuff on the blockchain, they want to do financing on the blockchain, they want to do insurance on the blockchain. In the future, all the payments will be predicated directly on you being able to transact with these participants without a third party saying yes or no. And so that's what we think the growth of that is. And there's no limitation on them bringing on real world assets such as gold, real estate, even stocks onto a platform where you have direct connection with the ability to transact with those instruments.
Yeah, so the immediacy or the directness of being able to transact. We're actually going to come back to that a bit later around economic agency. Thank you. bring that up, and we're going to come back to Tether. But I just want to bring Rupert in, because you're also very into crypto. You just told me you bought it at 10K. Do you think everyone should be buying it and using it?
Well, I mean, to start off, crypto is a really broad terminology. A ton of different types of assets and a ton of different ways to buy and transact.
Yeah, specifically Bitcoin.
So me personally, I actually put Bitcoin out on a bit of an island. I actually don't consider it a crypto asset anymore. I always consider it as something totally separate. I consider it its own investment class. And then crypto and the casino, that's something else. And some of those things in the casino will migrate into their own asset classes eventually. And we can have a longer debate on which ones those are. But ultimately, I look at Bitcoin as not a really efficient way of transferring cash. Like if I want to, give you $10, that's not a really efficient tool, but it's a really efficient way of storing that $10 and storing it so that it doesn't devalue over time. Now, sure, you could use other assets like gold, but then you've got to, if you're buying a gold ETF, you've got to believe that that gold ETF is being, the physical gold is being stored, and there's proof of that. And apparently, for many of these things, you can go to Switzerland and you can ask for your gold to be drawn out. I'm not sure how many people have actually done that. But it still means it's a physical thing, right? It's stuck in a location. There's a reason why we started using paper back when the Chinese kind of moved onto paper money, is because gold was really difficult to move. And so Bitcoin is that evolution. And so should everybody buy and own some? My personal opinion is that, yeah, you should always have something of a new asset. I mean, I still have gold, I still have some silver, I still have S&P 500 and loads of different asset bits and bobs around. I'm more pro Bitcoin, but you should just have one as a hedge. It's a safety net. And whether or not you believe in it or not, you should just have a little bit. I had this exact same conversation with another dad in the room, and I was just like, just buy some. Just buy a little. It doesn't really matter. Like, it's not going to make a material impact to your life right now, but it will if the world goes a certain way, and you need to have access to an asset like Bitcoin.
Yeah, okay, good advice. I'm going to bring Sashi in while we're on the topic of diversifying portfolios. What do you think about the broad range of asset classes that you've worked in, and where digital assets, which can include crypto, thanks for pointing that out to me earlier, could fit in a diversified portfolio?
Yeah, sure. I think my mic is working. So I came from very traditional finance, where you're dealing with stock markets, bond markets, etc. And digital assets has entered our ecosystem. And I think one thing that I like to point out when I speak to either my kids or their friends or my community is digital assets as an ecosystem is quite a broad term. Cryptocurrencies are one aspect of that. It's a value that you can buy, whether that's in the form of Bitcoin or Ethereum or another type of cryptocurrency. But as Kellogg mentioned earlier, there also are things like smart contracts. There are real world assets that are getting what we call tokenized, so they increase the access. And then there's stable coins, as we talked about earlier, which is basically digital currency, right? It's a digital form of fiat, whether that's US dollars or euros. But these are all ways that we can get exposure to digital assets. I think in terms of risk tolerance, portfolio diversification, everyone has different risk tolerances. So whether you're a student with your first taking your allowance and putting it in a savings account and figuring out, well, how should I allocate it? I mean, my son goes to school here and he said to me, Mom, can I open a MetaMask wallet? I want to put some of my savings in, he was tracking some coin that just launched. He's like, I could have made 800% today. And well, we need to walk through this together. There are many different risk tolerances that people will have. But I think the important thing to notice and recognize about digital assets is it's a new representation of whether that's currency, whether those are different types of assets like real estate, smart contracts, which as we were referring to earlier, could trigger events to make it more efficient for you to receive, let's say, a payment on a bond. So the smart contract can be programmed essentially to trigger those events and ensure that the payments are being made in a timely and efficient way. So I think what we're really talking about here in digital digital assets is reducing friction, creating additional access. So broader communities can access, digital currencies, can access tokenized versions of real estate, and really democratizing access. I think everyone's heard this term a lot, but that's truly what digital assets is doing. It's helping to democratize access for different communities, countries, and folks that don't maybe have access, and also people that are unbanked, and hopefully you've heard that term a lot, and especially for women. I'll talk about that. I mean, in a lot of countries, many women don't have bank accounts and aren't able to, are not managing household finances, and so creating ways for increasing access is becoming really more about what we're talking about in digital assets here. I think the other thing I wanted to mention, because we talked about this a bit, and just in case there's students in the audience and folks that are not as familiar, when we talk about these transactions, there's something called settlement. And settlement is really that exchange of, I'm buying this, I'm getting cash, or I'm getting that receivable in return for what I just bought. So in traditional markets, that can take a few days. Like, settlement can actually take a while depending on what you're purchasing. But in digital assets, it can take seconds, it can take minutes. And so creating that efficiency around, well, my transaction settled instantly and I can actually see that on my phone, that's a game changer. Rather than waiting for an intermediary to say, okay, I got your wire, you'll see it on Monday. It's really inefficient, and I think the way that we're all moving these days, we don't really have the patience for that. And then as we talked about smart contracts, think about these as digital contracts that are programmable, that can actually trigger events to make transactions and investments more efficient.
Thank you so much.
Sure.
Great overview of lots of things, and simplified for us, so I appreciate that. Sure. And it's interesting that you're delineating between the concept of risky sort of crypto type investments and actually the broader asset class providing a lot of increased access and, like you said, making it easier for people to invest who might not have been able to before. Sticking with smart contracts though, I'm going to segue back to Kellogg, who is building a business sort of founded on smart contracts. Could you tell us a bit more about what that means and how it might mean beginning of the end of regulation as we see it in the financial markets?
Sure. So I guess before I do that, how many people know what tokenization means?
Maybe 10 hands.
10 hands, okay.
15 hands.
Okay. Mm-hmm. All right, great. So let me start by just simplifying what tokenization actually means. So tokenization is real-world assets, so let's call it financial agreements, contracts, or real estate, and making a digital record of that asset, right? And the reason why you would do that is it's not changing the asset, it's just changing the process itself, right? So you're making it more efficient. So if you look at, in my business, Trusted Builder, what we do is we tokenize real estate. And there are financial agreements put in place beforehand that states that this property is worth this much amount of money. If certain milestones are hit, then the funds will be released, and the property is then transferred over to the new owner. That's what a smart contract is so you're essentially defining these certain variables for that smart contract to perform and release, whether it be funds or a certain contract or milestones or whatever it may be. So smart contracts are just very smart forms of being able to do a transaction itself. I think you're seeing it changing, the way that payments are done. So payments can be made to overseas. It's instant settlement as well. If I look at today, the banking world itself, if I want to transfer money from Portugal to the US, it would probably take about 3 to 5 days, right? Because there's some guy at a bank that has to push a button for the funds then to get released. You have all these intermediaries in between, and those intermediaries are stating, okay, this money is being transferred to the US, why, what, all these compliance levels. And with smart contracts, the compliance is built into the smart contract itself. And that's what the beauty of it is. It's more efficient, it's faster, compliance is built in, and all of these different layers, which just make it a much smarter way of doing business.
Yeah, thanks. I think that's an example that we can probably all relate to international bank transfers. We've probably all seen those speed up, haven't we, in recent years? Okay, we're going to do a little segue into business profitability, because I think this has some relevance with the financial sector. And I wanted to ask, Ivan in terms of the sort of hockey stick level growth, and you did reference Tether earlier as a fintech company that's seeing huge profitability per employee, I think at 100 times the ratio of kind of the investment banks that traditionally are always seen as being very profitable. What do you think that means for the financial sector, and can any other business ever hope to kind of reach that level, or are we just going to see a dichotomy now of the financial companies that are making mega profits and everyone else?
So a small correction. It's not 100 times, it's like 400 times. Just to be clear.
I think so, AI didn't serve me very well.
What the two companies are, Tether, which is a very boring company, it does a very simple thing. You give it $1, and what it does, it just says, on this blockchain, now you have a representation of $1. And it doesn't do anything with the cash. It just takes the money and it parks it in a large bank, or it buys treasuries or commercial paper, and it generates yield on that. It just happens that it has a lot of the money. It has $150 billion and is earning roughly 5% since the last few years. And so that amounts to a tremendous amount of money. And because of the operation is so simple, it only has like 100 employees, which means that on average, based on the revenues that it reported, it generated about $60 million in profit per employee. The next candidate, or the next best runner-up, is JP Morgan, one of the most established and well-run bank in the United States and arguably the world. And their profitability per employee comes out to be $160,000. And that's where you get the massive ratio that we were mentioning. And the irony here is that what does JP Morgan do for business? Well, they have a $3 trillion balance sheet. They will do credit cards, they'll do loans, they'll do debit cards, they'll do payments, they'll do auto loans, they'll do boat loans, they'll do credit sales and trading, they'll do private wealth management. All of that work combined, summed up, if you multiply, what is the percentage you have to multiply by their assets under management to work out how much profits they're making? They're making roughly about 1.something% of all their assets under management. That is their profitability. And they're one of the most profitable banks in the world. So you can see what that's going in terms of the efficiency. You have a bank that's essentially not even a bank. It doesn't even do loans and is making way more money than the bank that does absolutely everything under the sun and then some to make money. Now, if you think that, okay, well, this is the first most basic use case. This company, all it does is just gives you a unit of account so that you can transact on the blockchain. What are all the other use cases in which you can get that 100x, 1000x, 10,000x level of efficiency simply because you're cutting out the entirety of all those processes to generate those new financial products and new financial services for everyone else to use? Okay,
just moving on to Rupert quickly to come in on this topic of profitability. I've been showing the time token, so we're going to have to go quite quickly now. You have sold several businesses.
Yeah.
I've got to mention AI because every panel is mentioning AI. Do you think, how is AI going to make these financial businesses more profitable?
Well, I mean, everything that Ivan's talking about is what AI is doing. It's efficiency, right? You are focused on a very, thin edge of a business. Remittances wasn't a business that used to make tons of money, but they found a really good model here with Tether. How they can, and they can do it quicker and easier and with a few lines of code. And that's exactly what AI is doing. In our own business, we also measure revenue per head. We anticipate to never have more than 40 employees. That is a company that, in a traditional sense, would have 10x that number to be as efficient as we are now.
I'm aspiring to that. Just need to get rid of a lot of people. Right. Sashi, I want to bring you in again. We've lived through several banking crises. You've sat on the front row seat for 3 liquidity crises. Do you want to just quickly sum up or tell us what you think collateral mobility means and why it's more important than ever, because you think it's inevitable that we will see another crisis in our working lives?
Yeah, absolutely. I think we asked the question earlier, do folks understand or know the definition of collateral and think about it as assets pledged to cover a financial liability? And so I think some of us in this room have seen Lehman, the crisis with Lehman in 2008, and more recently SVB, Silicon Valley Bank collapse, Credit Suisse. So there's been a lot of large banks that we would all probably have thought of too big to fail, wouldn't go anywhere in our lifetime, have gone somewhere, and unfortunately either had to be rescued, bailed out, or otherwise. But what kind of stands true in all those instances is there were exposures they were either overexposed to certain asset classes, there was a liquidity and asset liability mismatch in what the banks were doing. And so if you think about what collateral means, if I gave you $100 and you gave me $100 worth in assets, if you ran away with my money, then I can sell your $100 in assets and I can be made whole, right? But when you give a bank cash, it's essentially, if it goes into a bank account, it's an unsecured loan. And so when you think about collateralizing a position, that is something that I think folks are thinking about. So I'll just sum this up, like when you think about how banks lend to each other, they do so on a collateralized basis, repo repositories. It's when banks lend to each other, one gives one cash, the other one gives the other one collateral. So if something were to happen, they can sell off those assets. And so essentially what the company I work for, Treasury Spring, actually was inspired by Lehman going down. So our founders had exposure to Lehman. They got 10 cents back on the dollar of the assets in the hedge fund. And they said, okay, how do we prevent this from ever happening again? Learned the lesson and basically created a new asset class called a fixed term fund, which is basically a fund that wraps a single debt instrument. And that debt instrument could be a treasury bill, it could be tri-party repo, as I talked about, that bank repo, or it could be commercial paper. And in this case, it's high quality assets that are backing your cash, and you know exactly when you're getting it back. So it's a term matched investment versus where there could be maturity transformation, which exists in money market funds. I think some of you may be familiar with money market funds. Those are not term matched, and they have a lot of maturity transformation, and they're also commingled assets. So it's really kind of rationalizing that. So I think if more banks and the folks that surround that think about collateral risk liquidity a bit more seriously, I think we'll have less of these
let's hope so.
debacles.
Okay.
But that is what is inspiring some of these new firms like Treasury Spring and others to offer a solution to that issue.
Okay, I've already been called time, but I just want a really super quick 30-second summary from you, Ivan, because you brought up at the start this will be the most important panel, and we all need more economic agency. What do you think, really quickly, is the kind of biggest change in terms of our ability to democratize access to finance?
The biggest change comes from the fact that the overall cost of spinning up these financial products will go down exponentially. As you guys mentioned before, Kellogg mentioned tokenization. The difference when you're doing this in traditional finance is you have a lawyer, right? And you have the people that are filling out the forms, you have your regulators that are looking over it, you have approval process. The entire cycle could take 6 months in a very, very quick fashion, or it could be 1 or 2 years or 3 years. Previously, if you were familiar with some of the debacles in the United States regulation under Gary Gensler, it would just never happen. So no matter what you would do, you could not be compliant to issue certain products. Now, with the tokenization and the ability to use blockchain smart contracts to do that, these financial products coming down 10,000 times means that true democratization can happen. That means that even though you only have $50, you could potentially get exposure to a revenue share for potential real estate investment. You could access these specific instruments that typically were reserved for very accredited investors or sophisticated institutions that you could not before. And that actually brings out true freedom in terms of the ability to control your money, how it grows, and how to spend it.
Thank you so much, Sashi, Ivan, Rupert, Kellogg. Thanks a million. I've learnt loads. I hope you've all learnt something too. Thank you very much.